Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate filings. Today we're diving into a Form 8K from Momentus Inc. and trust me, it's more exciting than watching a rocket launch that might or might not explode. We'll unravel what a warrant inducement agreement is, why a company might offer one, and what it all means for investors. Think of it as a financial magic trick and we're here to explain how it's done. Momentus, a space infrastructure company, just entered into an agreement involving warrants. Warrants, in simple terms, are like options that allow holders to buy company stock at a specific price. This agreement, called an inducement agreement, is with a holder of existing warrants to buy Momentus's Class A common stock. So what's the big deal? Well, this holder agreed to exercise their existing warrants to purchase over 1 million shares of Momentus's stock at 1.93 cents per share. Now, here's where it gets interesting. Before this agreement, the warrants were exercised, but they'll have to pay fees and other expenses. $1 million to buy anyway. Momentus will receive around $207 million from this exercise, but they'll have to pay fees and other expenses. In exchange for the holder exercising their warrants early, Momentus is issuing new warrants called inducement warrants. These new warrants allow the holder to purchase up to twice the number of shares they just bought, which is a bit over 2 million shares. Essentially, the company is sweetening the deal to get the warrant holder to act now. There's also a promise by Momentus to file paperwork, so the holder can resell these new shares. This is standard practice, allowing the holder to sell the shares they get from the new warrants on the open market. Momentus hired AGP to advise them on this deal and will pay them around $145,000 plus cover some legal expenses. Think of it as hiring a consultant to help navigate the financial waters. The company plans to use the money they get from the warrant exercises for general business needs and to keep the company running while they look for a potential strategic transaction, which can be like a merger or being bought by another company. However, they are giving no guarantees on if they will find such an opportunity. It is worth noting that the company does not intend to provide further updates unless there have been material changes. The new inducement warrants have an exercise price of $2.07 per share and can be used after the company gets approval from its stockholders. These warrants expire 5 years after this approval date. The price and number of shares can be adjusted if there are stock splits or other similar events affecting the stock. Also, under specific conditions like a major change in the company, the holder might be able to get cash, securities, or other assets if they exercise the warrants. There's also a limit on how many warrants can be exercised, preventing any single holder from owning more than 4.99% of the company's stock after the exercise. This is a common clause to prevent any one person from gaining too much control. For those who want to dive deep, the actual agreements are included as exhibits to this filing taken now. Let's step back and analyze what this all means. Momentus is essentially incentivizing warrant holders to exercise their options, now bringing in immediate cash. This can be a good move if the company needs funds for operations or strategic initiatives. It also reduces the number of outstanding warrants that could dilute the stock later on. The downside, it could signal that the company believes the stock price won't rise significantly above the new warrant exercise price in the near future. Otherwise, why offer such a sweet deal? Also, issuing more warrants, even with a slightly higher exercise price, adds potential dilution down the road. Overall, this move seems like a way for Momentus to shore up its finances in the short term. It buys them time and resources to pursue their strategic goals, whatever those may be. However, I have to give my opinion. Looking at Momentus's situation, this warrant inducement agreement seems like a short-term fix. While it brings in needed cash, it doesn't address the underlying challenges the company faces in a competitive space industry. Investors should keep a close eye on how Momentus uses these funds and whether they can achieve sustainable growth. It feels like shuffling deck chairs while hoping for a smoother journey. Thanks for watching. If you found this breakdown helpful, give us a like, leave a comment and subscribe for more Corporate Decoder deep dives.